We're going to bring in Kingview Asset Management Chief Investment Officer Scott Martin, Gary Kaltbaum of Kaltbaum Capital Management. Both are Fox Business contributors. And former Dallas Fed advisor Danielle DiMartino Booth. Good to see you all. Scott, I want to go to you first because Nicole put it perfectly. The fact that there is more hope than there is fear, not only in the markets, but also in America in general. When you see down moves like this, we've never seen anything point-wise like this, but we have seen percentage losses even more than we saw today. But when you see it in the context of a healthy economy, a generally healthy economy, it doesn't last long, does it?
No, it shouldn't, David. And I'd throw on top of that a healthy earnings environment, a healthy administration, let's say, with respect to its attitude towards business out of Washington for the first time in 8 years. So there are tailwinds, and I think you and Nicole did a great job there. You know, Nicole talked about how if somebody's watching these markets tick by tick, or let's face it, today 50 points by 50 points, because it wasn't tick by tick, which is very unnatural, by the way, which shows you something's going on, as she noted. You probably shouldn't be in these risk assets. You should be in stuff like CDs, money markets, maybe a lot more heavy in bonds than you are in equities, just because there are risky areas that probably got overinflated, because that's what markets do. Gary Kay talks about this a lot. Markets overshoot on the upside and they overshoot on the downside, and now we're trying to find that equilibrium where fair value is to be attained.
Yeah, and you look at those numbers, Gary, it is scary, a 1,200-point loss. But you got to remember, we've had, what, an 8,400-point gain since the election in the past 14 months since the election itself. I mean, that's a huge gain. You pointed out earlier, it usually takes 6 or 7 years to get that kind of a gain. We've had it in 14 months.
Well, look, the good news is you are correct. 8,400 points in 15 months is about 6 to 7 years, as I wrote, and we really have not had a bear market since '09 of consequence. The bad news is my big worry. I think we have ended up here with a one-sided trade, everybody on their comfy couch thinking nothing can go wrong with the markets, and we may be starting to unwind this crazy, over-the-top, easy money that has been coming from our central bank and central banks around the globe, which I believe has puffed up asset prices. So I do believe there's probably some more to go, maybe a little bit more to go than most think. And I would not be surprised to give back half of what we got from the election, which would be another probably 1,500 points.
Okay, perfect segue to Danielle, who worked with the Fed. Danielle, what about that? It's clear that central banks around the world have been buying up too many assets over the past couple of years in order to keep the interest rates low. They want to, now that economies are beginning to get better, get healthier, they think it's time to unwind that. How much damage is that going to do to the markets beyond what happened today?
Well, clearly we're going to find out. I mean, if market history is any guide, then we will see a very robust turnaround Tuesday. We could see we could see up trading for the rest of the week. But to your point, last year it was as if Enron and Lehman Brothers and Bear Stearns and AIG, it was as if they all were crashing at the same time, because central banks had a record $2 trillion of quantitative easing pouring into the markets, which put all of us clearly on our comfy couches. This year, though, that run rate is expected to be cut in half, $2 trillion to $1 trillion. And if the stock market is as it's supposed to be, is as it's advertised to be, a forward-looking mechanism, then it's potentially anticipating, you know what? The doctor's only going to give out half of the methadone to the patient in 2018. Mm-hmm. We're going to start to anticipate that and sell off. Well, the good news is we did see the bond market rally today.
We did, but the bond market is in trouble, because what happens when the central banks give up these assets that they've been buying over the past few years is the marketplace is filled with all these bonds. And when you have too much of something, the only way you can make it more desirable if it's a bond is to raise interest rates. Won't that do damage to the market?
Well, you know, unfortunately for Jay Powell, he came out of the gate.
He's the new Federal Reserve chairman. Go ahead.
Today, he had a video up, and I was impressed with his poise, and he was very articulate. But he made the statement, you know, I'm happy that the financial system is so much stronger than it was back in '07, '08. And what did he get for saying that? He got a little flash crash on his hands. Think about Alan Greenspan, who came to office in August August the 11th, 1987. At least he had a 2-month honeymoon before Black Monday. But poor Jay Powell on his first day of work. Look what's
imagine this
him.
being your first day of work at the Fed. It's extraordinary.
I mean, hello. But the question is he
David.
going to blink? Is he going to blink and begin to truly unwind the balance sheet? Or is he going to pull back on that commitment?
We'll see. One of the guys wanted to chime in. Go ahead.
Yeah, David, I just wanted to add one thing. One of the outcomes of easy money is risk-taking and leverage. Margin interest as its highest ever times a zillion, and it is your best friend in bullish phases. It's your worst enemy in bearish phases as greed turns to fear very easily.
Right.
And somebody, let's say, that has 300,000 in stock, but 100,000 of it is on margin, that margin has to come off first. That fuels the selling.
Okay.
And I'm not even sure that's happened yet, so it's something to watch very closely.
Well, Scott, let's just talk about the economy for a second here, because the economy is doing damn well. All the indicators are positive, and we haven't had the full effects of the tax cuts to come in. We haven't had the effect of all of that cash that's been abroad coming back that's going to be invested here in the United States. We haven't had the effect of all of the raises in salaries as a result of the tax cuts and the extra bonuses. People haven't had a time to spend that money yet. Once all of that really begins to kick in a little more than it has, won't that give even more of a boost to the economy, and won't that reflect itself in a healthier market?
Yeah, I think, David, that's the foundation to the floor. And don't forget the Treasury Department, my friends, which is getting record revenues of taxes in. So that's even before the passage of this tax cut, which I believe is going to generate more tax revenue down the road.
That's not what the CBO says, by the way. They don't believe in the positive effect of tax cuts the way you and I do.
Yeah, right. And then let's look back in the history of the CBO and how right they've been.
Exactly.
My goodness. But I'll tell you what's interesting, right? I mean, and they have an agenda just like, we've seen before on some of the other think tanks. So the point is this. That is the floor, though, because unlike, I'd say, 07 or unlike even 2000, valuations, in my opinion, aren't terribly extended. There aren't those warning signs, those signals flashing as they were back in previous crashes that said, hey, things are topping out. Things are actually, I believe, just starting to reaccelerate.
Well, Nicole, the problem with the marketplace, and a lot of folks out there realize this, is that sometimes the stock market doesn't reflect the economy. During the Obama administration, sometimes the economy was terrible, yet the stock market was going up. Now it might be just the reverse. In fact, we got great news about jobs on Friday, but within that great news, there was the details about people getting more money, which is good. Everybody wants a better salary, but that concerned a lot of people about inflation, whether or not that's going to stimulate inflation even more than it already has been stimulated. Did that spook the markets? Nicole.
Wage growth obviously has been front and center, and that's something that we've wanted. When you start to see inflation, you're going to see rates going up. That could technically spook the markets, but you shouldn't think of rates going up. We're coming off of historic levels. It's more of a normalization of rates moving higher than it is rate hikes. Wage growth is wonderful. That's what we want to see for the American people. What is a little worrisome is the Nikkei. Japan has opened up down 4.5%. Korea's Kospi's down over 2% this morning. And we're seeing this divergence with our own futures looking higher, but after the bell, they were looking lower. Expect some volatility and some volume tomorrow morning.